very good evening. It's 5 p.m. on the clock, which means it's time to kickstart Rise with India Prime Time. And as always, we will do so with the Money Show, your one-stop destination for all money matters. I'm Mubina Kapasi, and here's what we have lined up on today's 1-hour episode. Diwali is concluded, so I'm sure a lot of you, or at least a lot of your kids, may have received some very neat and tidy sums of money for Diwali from generous relatives. What are you doing with that? Are you just going to simply stash it away in the closet? Will you be spending it on frivolous items? Well, we've got a better idea for you. Why not invest it for your child's future? And we on the Money Show are going to give you guidance on how to do just that. Later, Harish Krishnan will be joining us from Kotak AMC in our Meet Your Fund Manager segment. And later on, in the Spend with TMS segment, car sales have certainly been good. If you have to go by Mercedes data point, 600 cars is what they have sold during Dhanteras. I suppose because of the hefty discounts. But as companies roll back those discounts, is it still a good time to buy cars? That's what we will try to understand from various auto dealers. But before we kickstart this exciting edition of the Money Show, here's a look at the headlines. LIC Chairman M.R. Kumar says it is too early for the largest domestic life insurance company to go public. In his first interview to a TV channel, Kumar says he reveals a neat 13,000 crore rupee profit on 33,000 crore rupees invested in the markets. Also adds that LIC is open to adding ULIPs in the portfolio now. The government is unlikely to accept the DTC panel's recommendation of slashing income tax rates before the budget. Sources say the government rules out tinkering with rates due to the lack of fiscal headroom, and cutting tax rates could mean lowering public welfare expenditure. That's an ET Now exclusive. EU panel backs India's war against terrorism in Jammu and Kashmir, but also insists that opposition leaders must be allowed to visit the valley. A day after taking a tour of Kashmir, EU MPs say abrogation of Article 370 is India's internal matter and the global menace of terrorism should be tackled sternly. Even as Shiv Sena remains adamant on the 50-50 sharing formula for the Chief Minister's post, Devendra Fadnavis gets a mark of approval of the BJP. He's elected as the leader of the Maharashtra Legislative Party. Also says people voted for Mahayuti and there will be no government formation without Shiv Sena. Delhi wakes up to a blanket of thick smog as air quality plummets post-Diwali. Meanwhile, environmentalists appeal to BCCI President Sourav Ganguly to shift the venue of the T20 matches outside Delhi, citing damage to the cricket team's health in the long run.
And for this Diwali, I got more than the last Diwali. I got 2,000 rupees from my Dada and Dadi. I got 4,000 rupees from my Mama and Dada. This Diwali was special to me. My Dadi gave me 500 rupees. My Nani also gave me 500 rupees. My Papa gave me 2,000 rupees. My Mama gave me 1,000 rupees. Yippee! Hi, my name is Manya and I'm 10 years old. And this Diwali I got 2,000 rupees from my Dada and 5,000 rupees from my parents. And I'm very happy because I even got to eat a lot of mithais.
This Diwali I got 4,000 rupees from my mom and dad and 3,000 rupees from my grandparents, which is a total of 7,000 rupees. I plan to spend 1,000 rupees in the orphanage that I go to every month, and with the remaining 6,000 rupees, buy a PS Pro game that I always wanted. Happy Diwali everybody, stay frosty.
Well, if that does not sound like your children, I don't know what does. Yes, Diwali has concluded and all of our kids have got some very tidy sums of money from generous relatives. You just heard out some of these kids. How ecstatic are they about just receiving that 1,000, 2,000, 3,000 rupees from their relatives, totaling almost 6 and 7,000 rupees. This certainly is an opportunity for them to build wealth and not to spend it off on items like PS4 and chocolates and ice cream, as a lot of kids want to do. And I suppose it is a great opportunity for you as well to teach your kids about saving and investing. So, to give you a guidance on that, let me bring on board Mrin Agarwal, founder director of FinSafe from Bengaluru. Mrin, thank you so much for joining us on the Money Show as always. Mrin, I don't know if you heard of the entire the whole script that we had before. We had 4 or 5 children telling ET now how much they managed to accumulate as Diwali gifts from their relatives. Before I get into financial planning, etc., I want to ask you, do you know what the term stay frosty means?
I'm sorry, I didn't hear that. Do you know what the term?
Stay frosty. That is something that one of the kids signed off as stay frosty. Do you know what it means?
No.
Well, it's brand new lingo, Mrin. This is something even I've never heard before. It means be ultra cool. So there you have it, Mrin. You don't only impart your knowledge, you I think gain some knowledge as well on the Money Show.
Wow.
But anyway, you know, like I was saying, kids get a lot of money from relatives, from grandparents, parents, etc. During the occasion of Diwali. And you know, Mrin, it's not just Diwali. In India, we have several festivals: Holi, Eid, Christmas. Many people get money for Holi and Eid and Christmas and Diwali, like I do, because I'm a Muslim, so I celebrate Eid. I love celebrating Christmas. I love celebrating Diwali. So it's just occasions, you know, to get some more money from my relatives. But and this is an accumulation over a period of many years, right? So it's a tidy sum of money that has been accumulated, and more often than not, or at least I know in my family, the money used to just lie in my mother's closet. But don't you agree, Mrin, that there's a better place perhaps for that money to be lying instead of in, you know, a closet or being spent off in frivolous items?
Yes, absolutely. There is certainly a better place for that money rather than the closet or it getting spent immediately.
Mrin, you know, these kids, of course, they are young, they have time on their side, and more often than not, you know, parents would like to invest it. Mostly it's for the education, right? I mean, education is a priority for the children. So how would you exactly advise them to go about investing the money? Because again, we have time, and we often say on the Money Show that if you are a long-term investor, then equity mutual funds is the way for you.
Well, first and foremost, I really think that before they actually invest the money, they should actually open a bank account in the child's name. These days it's very simple to do so, and you know, the advantage is that for children who are above 10, they also have an ATM card that they can use. So I think firstly they should really open a bank account in the child's name, because it will help getting the child to get some practical knowledge on how a bank works, and more importantly, you know, what are the things to watch out for, because these days, you know, we are hearing so many things on phishing, and you know, of course, the digital space is really not without its faults, right? So I think it will also make kids aware as to what are the things that they need to be cautious about when they're doing digital transactions. Now, in terms of investing the money, I think what they really need to do is that they need to leave some money aside for the child to spend. So for example, if the child has been given 100 rupees, you know, they could say, okay, so you can keep 20 rupees aside for expenditure, and 80 rupees, that's 80% of the money going towards investments. On the amount that is kept aside for spending, I think some amount should be allowed to spend for stuff that kids want, which parents don't let them buy otherwise. And a portion of the money should also be kept for larger wants that the child might have. And this way basically we're trying to teach the child the importance of saving and the importance of delayed gratification. So that's really in terms of financial habits. Coming to your question on how do you invest this money, of course, there are a lot of investment options that are available, like equity mutual funds, balance funds, and debt funds as well. The other options are also PPF and Sukanya Samriddhi, but of course these are much longer term options because they involve locking in the money for more than 15 years. So these are typically the options that are available, and essentially one needs to choose this based on one's risk profile and of course how far away the education goal is.
You actually answered my next question as well, and that was with respect to how parents using this money can actually give some very valuable financial lessons to, to their kids about not just how much you have to save, but also the basics, of how the bank account operates, how exactly do checkbooks, etc. work. If you want to access your money, how does a savings account work, so on and so forth. So this could be a great opportunity. Now, Mrin, just once again then bringing my question and focus back on investing in, equity mutual funds. Now, this money is not something that comes every month. If I'm a salaried employee, or even for that matter, if I have a business, I know that every month I can put aside 1,000, 2,000, 3,000 rupees. This is very sporadic money. It just comes maybe once in a year, twice in a year, etc. So in such a scenario, how should one maintain an SIP then for kids? Or would you advise then bulk investing or investing in totality?
Given that the amounts may not be very, very large, even a lump sum should be okay as long as the investment holding period is more than 10 years. I think, if the amounts are like even up to 10,000 rupees, I think it's okay to do the lump sum because, obviously it's difficult to kind of put it away in a SIP because you don't know, first of all, how much money is going to come. So in that scenario, lump sum should actually be okay. In case if you do have a fair idea that, okay, during the year this much money is going to come in through gifts, then obviously you could look at doing a SIP. But I think either way would work as long as you have a long-term holding period.
Okay, all right. Well, on that note, let me also invite all our viewers that if you have any questions or queries, you can send them in and Mrin will answer them with respect to your portfolio, your kids' portfolio, how to go about investing for your children. You can always get all of these questions answered. But for now, let's bring on board our very first caller. Do we have him online? Okay, I think it's Mr. Pani Durai joining us from Kanyakumari. Good evening, sir. Thank you so much for joining us on The Money Show. What's your query?
Yeah.
Sir, what's your question?
My name is Thomas Ray. I'm working in Mumbai.
Yes.
My salary is 50,000.
Okay.
I'm doing part-time job in insurance.
Okay.
Insurance agent, LIC, and this.
You work as an insurance agent, is it that?
Insurance agent. Then part-time job is insurance agent.
Okay. Okay.
Working full-time job is Mumbai offshore. This is
Yes, sir. Go ahead.
job.
Okay, so you have a part-time and a full-time job. You're an LIC agent. You're working in Mumbai, sir. So what's your question?
I want to invest this mutual fund.
Okay, all right. You want to? So you've not invested anything yet. You're going to start investing now, right?
Yes.
Okay, and you want to invest for the long term?
This SIP in mutual fund SBI.
Okay, you already have SBI mutual funds.
Yes.
Do you know which? Okay, do you know which category is it in the SBI? Large cap fund or anything?
This is no idea, ma'am. I have started this 1 year before. I have no idea this how I have started in the bank.
Okay, all right. So it's just one mutual fund, Rin, that he has, and he does not exactly have a lot of information about the mutual fund, but that too can be a bit dangerous. So, Rin, if you could also educate our viewers about how, about awareness of the funds that you own, that's very important. And also, of course, how you would advise him to essentially diversify his portfolio, not just have one fund, but perhaps an addition of a few more funds.
So I think first and foremost with his PAN number, because I'm pretty sure that he's KYC registered, so he can approach the SBI mutual fund office with his PAN number and he can source an account statement from there, by which he'll get to know what is the mutual fund that he owns. So that's as far as his documentation is concerned. The second thing in terms of diversifying into other funds, well, first and foremost, sir, you need to know what is it that you're investing your money for. So what is the financial goal or what is the end use of the money that you have? And once you know that, and once you know what is the holding period that you have for the investment, you can either decide to choose debt or equity funds. Clearly, if you're looking, I'm presuming that you're looking at an equity mutual fund SIP, and for that you need to have at least a 7 to 10 year holding time frame. If your time frame of investment is less than that, certainly don't go with an equity fund. I would suggest, since you're just starting off investing in mutual funds, stick to multi-cap funds.
Okay, multi-cap funds is a good option, especially since you are just starting off. That's something that, you know, Mrin is advising, and of course you could follow those steps as well that she said. Everyone is literally KYC compliant now, which means the bank, the financial institution has your PAN card or your Aadhaar number. All you need to do is use your PAN card to get a detailed statement of which mutual funds you hold. And I'm not saying you own an SBI mutual fund or an HDFC. Within SBI, there are several you know, funds: a large cap fund, a mid cap fund, small cap, tax saving, multi cap, so on and so forth. It's important that you know what funds you own. Okay, we have Ravi Kant from Hyderabad who's joining us now on the phone line. Hi Ravi Kant, good evening. What's your question?
Very, very good evening, both of you, madam, and as well as to the back-end team also. And thank you for taking my call, right?
You're most
Actually, I'm a long-term investor. For the so many years, I am investing in mutual fund schemes, several schemes.
Okay.
For tax benefits, I am investing in via SIPs in two schemes. One is Axis Long-Term Equity Fund and the Reliance Tax Saver Fund.
Okay.
And Reliance Tax Saver Fund is not doing well. It seems to be not performing well. Whereas the Axis Long-Term, a good return,
Is doing very
I got
well,
it.
yes.
And still continue. I can continue it for another 3 years. For the last 4.5 years, I am investing via SIP every month, 5,000 each in two schemes. Okay, what shall I have to do? Shall I have to continue that Reliance Tax Saver Fund, or else I have to cancel the SIPs and start investing in some other scheme? Tell me, madam. Tell me, madam. Yes. Right.
Okay, sir, you want to redeem these funds next year, is that right?
No, I want.
Okay.
I'm not interested to redeem. I can continue it. If we in future, if Reliance Tax Saver Fund will do well, I can continue it.
You
for
can
another 3
continue.
years also.
Okay. So you do have time. All right. So Mrin, Axis, I think many schemes have done very well. Small cap, mid cap, the India Equity Fund. It's been a great year as well for Axis. But yeah, maybe not so much so for the Reliance funds. What would you advise him to do, Ravi? Advise Ravi Kant to do. Sorry.
I think what he mentioned was that he's been investing in these schemes for the last 4 years, if I heard it correctly. You know, I think all funds have cycles, and there might be some cycle of underperformance in the Reliance fund. Ideally, what he really needs to do is look at how the fund has performed versus the category average, and only if there is underperformance over 6 to 8 quarters do you really look at exiting, because there will be times when certain funds do very well and certain funds don't do well. So only if he sees the sustained underperformance, like for 1.5 years, does he really need to exit.
All right, Mr. Ravikant, I hope you heard out that advice. And of course, for mutual fund investing, for SIP investing, patience is extremely important. We get many callers who say, that I started investing in a small and a mid-cap fund 2 years ago, but the NAVs have been completely depleted. Well, that's because of the way the small and the mid-cap indices as well have performed. But, it is in such times that you start accumulating because of course, a basic lesson is you buy low and sell high. So yeah, take advantage essentially of these lower funds as well. Okay, let's take on board a couple of email queries. Let's see the very first email query that we have received today. And this one is from Mr. P.P. Bobby, one of our regular viewers. He emails us saying that I have invested 50 lakh rupees in the HDFC Liquid Fund. Considering my age, and by the way, he is 78, he is above 75 years old. Let's put him in the above 75 years old age bracket. Is this investment the right way to go? Now, I am assuming that the 50 lakh rupees is the only money that he has, and it is parked in the HDFC Liquid Fund. Unfortunately, he has not shared with us any other parameters, like for example, does he need some monthly income that needs to be generated? That would have perhaps been a bit more helpful. But anyway, Mrin, what would you recommend?
Well, given his age and probably his risk profile, it's not a bad investment as long as it's for parking surplus and really not for generating monthly income, because I don't think, the returns are not going to be that high to really give him good amount of monthly income. So, from a risk perspective, of course, it's very low risk, and the thing that he needs to remember now is that there is an exit load before 7 days. But really, from the risk perspective, it's fine. But if it's to generate monthly income, then it's probably not the right investment to do.
Not the right investment if you're expecting some sort of a monthly income from it. But yeah, if you're using it to park surplus funds, definitely better than it lying in a savings account, because there is a bit extra return that these liquid funds do give. And of course, accessibility as well. There is that exit load, of course, but I'm assuming that you're investing it, you've already invested in it for more than 7 days, so that'll be obliterated. And yeah, if in case, God forbid, there's any emergency, you can easily access the money too. So in that parameters, it gets a tick box. Okay, let's take on board our next query. It is coming in from Vinay Bhasin. And, before I take on board this query, let me also remind our viewers, our phone lines are open. You can call in on 2499-0300 right now and get your portfolios well analyzed by Mrin. Or any questions or queries that you may be having. Let's take on board our next query. It is coming in from Vinay Bhasin, again a senior citizen. As he says, he's 71 years old. He has invested 13 lakh rupees in a DSP credit risk fund, and this was 2 years ago. The return is lower than 2%. He wants to know if he must exit the fund or stay put. Now, we usually talk about a mid-cap, large-cap, multi-cap fund, but this is a new one. This is a credit risk fund. And while we have discussed this in the past as well on the Money Show, because a credit risk fund essentially, as the name suggests, it is dependent on various credit events. And we know what's happened in the last 1 year. Things have been a bit murky on that front. Mrin, if you as well could explain to our viewers, credit risk fund, is it a good idea to invest in them? And of course, specifically for Vinay, he's 71, he has 13 lakhs parked, not doing well for him. What would you as well advise him to do?
Well, first and foremost, the advice would be to exit, because I think what has happened is that based on the yield to maturity, or the YTM, which translates into returns expectations for most investors, he's probably invested looking at the fact that it might be able to generate a higher return than some of the other debt funds. And obviously, the events of the last 1 year have played out really badly in this fund, which has seen a couple of defaults happening, and that is why the NAV has also taken a hit. So I'm not sure, from risk perspective, whether he can take the volatility. Now, as far as credit risk funds are concerned, these are funds which invest in lower rated bonds, essentially for the highest interest rate that these bonds give. But of course, this comes with more risk, because what it really means is if a company is willing to give you a higher interest rate on their borrowing, it really means that they're not able to access bank finance or cheaper sources of finance, and obviously it means that there's no surety of the money really coming back. Typically, it is, you would see some defaults happening, not as many, of course, and not to the level that we've seen in the last 1 year. So clearly, this fund is meant for people who understand how the credit space work and who are willing to take these sort of risks for the extra return that these funds may be able to generate over a longer term period. I think, for older investors who are really looking at generating a little higher in returns on their portfolios, these may not be suitable because of the volatility that's really involved, or the credit risk that's involved in these funds.
Mrin, I just would like to ask you a follow-up question. A credit risk fund, it's quite niche. It's a specialization of sorts. That brings me to thematic funds. Yesterday we were just comparing the somewhat to somewhat returns, and interestingly, you had some of the best performers were funds like the Consumer Trends Fund, the Banking and Financial Services Fund, the Gold funds. So it all the more, lures one that, hey, these thematic funds are doing very well. So I think even I'll put my money in a banking and financial services, banking and PSU fund, pardon me, or a gold fund, etc. And credit risk as well forms, in a way, does fall in that same niche category. But all in all, would you recommend thematic funds?
As such, I don't recommend thematic funds again, because they have their very good years, like you saw in the last 1 year, and they have their bad years. And the problem with most thematic funds is really the concentration risk that it comes with. So if you're aware about markets, and if you want to take a risk into a particular sector like banking and financial services, then it's okay to go for a thematic fund. But I think, for most investors, I don't think that they understand the risks that are involved, and the fact that, it could either do very well or it could do really badly. So I think it's better to then be with more generic funds like the multi-cap funds. And if you're willing to, of course, if you want to take a bet on that particular or couple of sectors, then go in for a thematic fund.
Thanks a lot, Amrin, for that. But we just got one more call. We've got, I think, Vivek calling us. Vijay, pardon me. Hi, Vijay. Thank you for calling in. What's your question?
Yeah, good evening. This is Vijay calling from Chennai.
Good evening.
So this is regarding the small cap funds.
Okay.
I have already invested into 5 different small cap funds. I'm naming it down like this. It is
Sure.
the HDFC Small Cap Fund, L&T Emerging Business Fund, Reliance Small Cap Fund, SBI Small Cap Fund, and finally Franklin Templeton Smaller Companies Fund.
Okay.
Now, I would like to trim down my portfolio. So I would like to keep only 2.
Yes.
So can you suggest me 2 out of this, and why?
Okay. Vijay, just a follow up. Do you have any other mutual funds that you've invested in? Do we still have Vijay with us?
Yes. Hello.
Vijay, have you invested in any other funds apart from these 5 small cap funds?
Yes. Apart from the small cap fund, I have already invested into multi cap and large cap fund.
Okay. All right.
So I would like to reduce my exposure on small cap fund.
You want to, is that because of the way the funds have been performing?
Exactly, that's right.
Okay, all right. Vijay, I think Mrin will agree with me, but this may not exactly be the best time perhaps to exit your funds. Yes, you may want to trim your exposure in general because you have too many small cap funds, but don't do it because of the fact that, okay, my funds are not doing well, so let me exit. Mrin, do you agree with me?
Yes, I completely agree. And also, the typical holding period recommended for a small cap fund is at least 10 years. So I think, probably your holding period might be just a couple of years at this point in time. And small cap funds are known to have a lot of volatility. So, first and foremost, I think, as Mubina said, that don't exit just because the returns are down right now. But however, you do need to do some trimming, because I see that you have 5 small cap funds, and then you've also mentioned that you have multi-cap funds and mid-cap funds as well. So you should really not need to have more than 5 to 6 funds in your portfolio. So from that perspective, you could look at some trimming, but it's not as if you just need to do it immediately right away. You could look at doing it over a period of time. So in terms of the small cap funds, I would basically stick with the Franklin Smaller Companies Fund and either SBI or HDFC. Those are the two funds that I would really stick with and look at basically exiting some of the other funds that you've mentioned.
All right. Okay. Ideally, don't keep more than 5, 6 funds, because a fund any which ways is basically diversification. And when you have so many funds, it's literally like owning the entire market. This as well is something that we've been saying time and again on the Money Show. There's a lot of overlap as well, because funds tend to have common stocks that they own. So you're just simply over owning one kind of sector, one kind of stock. So don't keep too many funds, uncomplicate it, and yes, decrease your exposure. Vijay, I hope this advice has come of use to you. But on that note, we have out of time on this edition of Ask the Money Show. If we've not been able to answer your query, don't worry, we'll take it up sooner or later this week. Mrind, thank you so much for joining in and of course giving your guidance on how parents as well should handle the money that kids have received for Diwali. Quick break, but when we return, we are going to be talking about the Kotak Blue Chip Fund, and we'll be meeting the fund manager of the fund, Harish Krishnan. Hi everyone, welcome back. You're watching The Money Show on ET. Now, we just had a discussion on how you can handle and teach your kids about finances, especially after they received a neat sum of money for Diwali. But now it's time for our Meet Your Fund Manager segment. And today we decided to talk about the Kotak Blue Chip Fund that's being managed by Harish Krishnan. First, let's talk a bit about the fund that has managed to deliver a decent 10% CAGR over a 7-year period. And of course, the longer term, the better. 6.2% is the CAGR they've delivered in 5 years, but the last 1 year may have been a bit difficult. It's had a tough year, but that's really been the case with the rest of the markets as well. But like we say, mutual fund investing is for the long term. So let's just take a look then at what exactly are the constituents of the fund, which sectors, which are the top holdings. And of course, this one too has banks as one of the dominant, compositions. So HDFC Bank more than 9%, ICICI Bank 7.8%, and there's also Reliance Industries, which of course has been a great performer, that's gaining 8.4%. In fact, both of these stocks have done very well. Moving on, among the other big and top holdings, what exactly features? There's also an Axis Bank, 4.7%. Infosys, which of course has been rattled with all the corporate governance issues, that is 6.7%. And HDFC Limited is around 5%. So yes, both the HDFC twins do hold a dominant position. Moving on, more from the banking space, there's Kotak Bank, 3.8%. And giving Infosys company, there's also TCS, which is around 4.6%. L&T, Cap Goods Major, is 3.6%. So these are roughly the top 9 or 10 stocks in the Kotak Blue Chip Fund. As the name suggests, the bluest of the blue chip names are some of the top holdings of the Kotak Blue Chip Fund. And of course, as you may have seen, banking and financial services on a sectoral basis is right on the top, followed by IT. The riskometer indicates that this one has a moderately high risk. It's not exactly a moderate risk, it's moderately high. So if you have a very, very low risk appetite, this may not be the one for you. Well, now that we've dissected the fund, let's bring on board the manager, since this is the Meet Your Fund Manager segment, Mr. Harish Krishnan. Harish, thank you so much for joining on the Money Show. Like we were just saying, it's been a tough year, but nevertheless, again, in the long term, a 10% CAGR, not that bad. Let's start off first by what exactly is the investment strategy and style for the Kotak Blue Chip Fund?
So out here at Kotak Blue Chip Fund, we are primarily a growth and quality at a reasonable price. The idea is to focus obviously in the large cap space, look at sectoral leaders who have invested in their businesses in the downturn, the down cycle for various businesses, and as the upcycle or the demand improves for their respective products, they will make the most out of that opportunity. So broadly, the style is growth and quality at a reasonable price. We are not necessarily value investors. We are looking at businesses that compound. We are looking at companies which have very strong cash flows, which have a reasonable amount of return on equity, and which are far more sustainable. Therefore, even in a down cycle can sustain their business over a long period of time. So that's broadly the style and the philosophy of the fund.
What is the risk and return expectation that investors or potential investors must have when they want to invest in the Kotak Blue Chip Fund, Harish?
So broadly, this is clearly the universe of the fund is clearly the blue chips of India. Essentially, it is our firm belief that companies that grow reasonably well ahead of their sectors, have got good return of capital deployed, have a fundamental reason to compound wealth over a long period of time. Given the fact that these are sectoral leaders and in most cases have very strong track record of maybe decades of operating in India, across various business cycles, we continue to believe that the long-term opportunity set continues to remain extremely robust in India, and which means that we continue to believe that longer term returns over a 5-7 year period cycle will essentially track two things. One is the earnings growth of the portfolio, which at this point of time is currently close to about 17-18%, and the return of capital deployed, which at this point of time again is around 15 to 16%. So over a long cycle of over a long period of cycle, we think that stock prices would gravitate towards the growth of the portfolio as well as the return of capital that the portfolio inherently generates.
What should be the ideal time horizon for investors as well looking to put their money in the Kotak Blue Chip Fund?
So clearly, equity is an asset class with which requires very patient capital, and we've seen historically so many cycles wherein the downside or the ability of equities as an asset class to at least give beat inflation or to at least give you a bond yield plus some kind of risk adjusted return goes up materially as we move in time. So anytime above 6, 7, 8 years is when the probability of any fund or of an asset class like equities giving you returns which are below say the bond yields moves down quite dramatically as we move in that 6, 7, 8 and beyond time horizon. So longer the time horizon, better the odds for any investor are in an asset class like equities. At this point of time, obviously with valuations the way they are, definitely investments into an equity fund will have to be necessarily be extremely long term at this point of time.
We've read a lot about defaults and defaults by companies, and that's something that's hurting mutual fund NAVs as well. So, Harish, how do you weed out the bad from the good?
No, so essentially, I think this has really been the hallmark of all our funds at Kotak Equities, wherein while we may not have got necessarily the big up movers, stocks which have gone up, say 50x or 100x over the last 5 years, what we have been reasonably very prudent about is that we shouldn't be having a lot of those companies which have destroyed wealth, by 80-90%, and that essentially has been, the fact that across the board we've got funds, be it in the large cap, multi cap, or the mid and small cap space, which have avoided or which have had very minimal exposure in our portfolios. And I think it all boils down to 2 or 3 key prudent measures that we look at when it comes to investing. First is, of course, diversification. We all have diversified portfolios, which reduces the risk intensity of a single company going bad. But more than that, we look at the cash flow streams, how sustainable they are. Are they dependent on external capital for their growth ambitions? And which is where again the focus on ROCs come into question, because sustainable across the cycle return on capital employed, if they are in strong double digits, that can support business growth to the double digit level as well.
You know, Harish, it's a bit of an industry-related question that I'd like to ask you, but do you believe that these SEBI recategorization norms are perhaps making it difficult for you to operate the fund?
We've been operating within broadly these ranges for now more than a decade. For example, in the blue chip fund, our universe has always been, that at least 80% needs to be in the top 100 stocks. Of course, it was at market cap at any point of time. The SEBI's orders are that on a 6-month basis, they provide a universe of 100 names. So there can be maybe 5 or 6 companies, which are on the border. But by and large, we've always operated within the same framework. So we don't necessarily think that, this is a reason for hampering or reducing the performance ability of an active fund manager. We have always maintained that being disciplined helps. Yes, it needs a performance across a cycle to demonstrate that. So there will always be phases, of 6 months, 1 year, wherein there will be phases of underperformance. But across cycles, we have demonstrated that we can compound wealth faster, and we don't necessarily believe that, especially in the large cap space, that these SEBI criteria are in any ways prohibiting overall performance of active fund managers.
Okay, and Harish, finally, if you have a message to share with your current as well as prospective unit holders, what would you like to say to them?
So I think this is a fund that focuses on clearly the well-established giants. There is a perception that these giants can't grow because they are too big, and there is enough history and track record of these companies that have seen so many different business cycles. And it is important to understand that companies operate in cycles, and therefore you focus on these kind of sectoral leaders which have the ability to sustain during a down cycle, actually make the most in an up cycle. The second message I want to convey is that please look at investment into these funds across a cycle. A cycle would be anywhere between 6 to 7 years, and that is where the true discipline of investing in such kind of sectoral leaders actually proves and therefore can add value to the wealth creation journey of all our investors.
All right, Harish, thank you so much for joining us on our Meet Your Fund Manager segment. I'm sure a lot of the investors of Kotak Blue Chip Fund 2 have got a lot of information from this conversation, and even our prospective unit holders. Quick break on the show. We'll come back with our Spend with TMS segment. Everyone, and welcome back. You're watching The Money Show on ET Now, and it's time for our Spend with TMS segment, where we help you make the right spending choices. Now, if reports are to be believed, people have really gone out and spent a lot on cars, because this Diwali and Dhanteras has been all about autos. Be it in any shape or size, sales have certainly increased. So we thought we'll talk about what led to this high sale, and also what's the current status when it comes to discounts, offers and pricing now that the festive season is over. Let's bring on board Nikunj Sanghi. He's the chairman of the ASDC, the director of FADA, which is an auto association, and the MD of JS Four Wheelers. Mr. Sanghi, thank you so much for joining us on the Money Show, sir. We understand it's been a great, festive season for automakers. People have really gone out and bought cars. Has it really been the case, and has it been across segments, be it your sedans or an SUV?
Well, definitely a wonderful festival season, and yes, across segments from two-wheelers to passenger cars to UVs and sedans, high-end sedans. I think the only exception being the MNHCV sector. I think MNHCV sector continues to be under stress, and we have not seen any uptick on. So if you look at Dhanteras, I think Dhanteras was one very, very big day, and it was much bigger than the Navratras that we had. And if I talk about my own dealership, I think it was the single largest retail for a day in our history of the dealership, both in two-wheelers and in our Mahindra portfolio. But all this comes with a rider. The rider is that if you look at the entire festival season, which is a 32-day period which starts from the day one of Navratra and which got over yesterday with Bhai Dooj, I think if you look at that period, then it was not a very, very big increase over last year. And last year, as you would know, was a bad year. That's when the auto slowdown really started. So, but what changed was that we were going through a downslide, and I think the downslide was arrested. And in most segments, we were either flat or we had even grown by single digits, whether it was two-wheelers, passenger cars, or UVs. I think everything was either flat or had grown. Another word of caution is that this was not uniform across the country. If you look at geographies, I think some states did exceptionally well, starting with Chhattisgarh, Madhya Pradesh, Rajasthan. States which did not do well was definitely the South and the West. South, of course, this festival season is not big. And in the West, I think the delayed rainfall dampened the spirits in the West. So Ganesh Chaturthi was not good, and nor was Dhanteras Diwali. But otherwise, I think it was fairly widespread and good for auto dealers, good for OEMs.
Did we also see a lot of discounts being offered? Because, we had almost 1 lakh rupee discounts that Maruti was offering, if we have to include exchange and corporate discounts and everything. So do you think that we saw big discounts as well during this festive season?
The biggest ever. The biggest ever in my experience of 35 years as a dealer. I have not seen this kind of discounting ever before. So definitely, like I said for some of the previous shows, that this was the best time to buy your car if you needed to buy a car. I think everybody had a deal. Each manufacturer had a deal, whether it was two-wheelers, cars, any brand. Brezza and Crista, which are the fastest selling UVs in the country today, which had a waiting list till a few months back, offered discounts like 80,000 to a lakh, which we couldn't dream of as dealers ourselves. So definitely the best time to buy and the best ever discounts this industry ever offered.
Mr. Sanghi, you mentioned this was the best time to buy a car. Have the discounts been withdrawn, that means?
Well, I think if you still want to buy a car, you have another day to go, because these schemes apply till tomorrow.
Okay.
But the sense is that most manufacturers will either reduce the schemes or even withdraw the schemes. In fact, Maruti has very clearly stated that most of their schemes will be withdrawn post 31st October or post the festival season. And the reason why I think these will be withdrawn, because inventory correction has taken place. Inventories across segments are much, much healthier than what they used to be. And my sense is that across the country, inventories in all segments will be less than 30 days, and which is what we were looking for, and which probably gives the right platform to transition into BS6. So I don't think you will get the kind of discounts that you have got this month anytime in the near future.
Mrs. Sanghi, is this only for the BS4 or did you even see it for BS6? And also, what about that BS4 inventory? I mean, many a times we've been seeing these huge ads being posted on newspapers, etc., that, never before seen offers on BS4. So is that still there?
So that's what I said. I think the discounts were there across segments, and irrespective of BS4, BS6, because if you look at Maruti, 8 of their models were BS6 models and they were offering discounts even on those. So I don't think it had to do with the BS4, BS6, it was discounts all across. And these discounts were offered so that BS4 inventories would come under control. We still have 5 months to go and the inventories are well under control, and I'm sure there will not be any need for a fire sale in February, March when everybody would want to do away with their BS4 stocks, because I also feel that most manufacturers will in a phased manner start manufacturing BS6 vehicles come November, and the production of BS6 vehicles will start and inventories will get replaced in the showrooms slowly. But by March, I think every showroom will have sufficient BS6 inventories to go into the next financial year.
Mr. Sanghi, you have been in the industry for 35 years, so I can't see a better person to ask then. Of course, most of the launches have concluded before the festive season, but this time around the launch was also a little slow. We just had a few cars launching. But anything that you are watching out for in terms of new launches between now and, next year, over the next 6-7 months, be it in BS6 or even in the EV segment for that matter?
So I think there will be launches, but I think most launches will now take place in BS6 segment. And because they'll take place in BS6 segment, I think most launches would be scheduled nearer the end of the financial year or maybe even the next financial year. As far as the EV space is concerned, I don't think we will see very big launches or very big volumes coming in the EV space, because the FAME 2 policy, if you read it in detail, is focused on encouraging public transport and not so much on personal transport. So after the launch of FAME 2, you would have also noticed that two-wheeler sales, the e-two-wheeler sales have actually gone down because the FAME 2 scheme does not favor the EV two-wheelers which were being sold, and the government is focusing only on public transport. So which means commercial vehicles, buses. I think those are the places where an e-vehicle is not just an e-vehicle, it has to be a mobility solution. So which means there has to be an infrastructure around it in terms of charging stations or battery swapping stations. I think all that needs to come in. So EVs is the future, but will take some more time before you can really see very, very big numbers of EVs. And I think most EV launches will wait till a proper policy of the government comes in terms of encouraging EVs in personal segment space and not just commercial segment space.
Okay, all right, Mr. Sanghi, thank you so much then for joining in. It certainly was the best time to buy a car, and you just have 1 day left. So run right now to the showrooms and perhaps consider booking your automobile, because never before seen discounts. And this is the word coming in from Mr. Nikunj Sanghi of FADA himself. But on that note, we will wrap it up on this edition of The Money Show. Folks, thank you so much for watching. Do stay tuned. Do keep connecting with us. Send in your feedback on the show on The Money Show at ETnow.tv.